Hi there, this is Simon, personal finance coach. In this video, I will break down the top IRA and 401k mistakes that people make, costing them lost savings and jeopardizing their retirement plans. We will learn what these mistakes are and how to avoid them to keep your retirement on track. Before we dive into details, let's take a quick look into the origin of the retirement system in the United States. When President Roosevelt signed the Social Security Act in 1935, it was intended to supplement personal savings, not to replace them. At that time, the average American lived only about 4 years in retirement. The act was never intended to take care of people living 15, 20, or more years in retirement. What the government realized over time, that there were a lot of people that were entirely relying on Social Security. They had no savings and no other source of income. So, in order to lessen public's dependency on Social Security, Congress passed in 1974 a set of laws that gave birth to IRAs and 401ks. The purpose behind these laws was to give Americans incentives to plan for their own retirement. The government gave incentives for tax deductions on contributions, tax deferral on gains, payroll deductions, and exemptions from creditors. And the incentives came with taxes and penalties, such as fully taxable distributions at personal income rate, 10% penalty for withdrawals before age 59 and a half, and 25% penalty for failing to take distributions at age 73. This introduction leads us into the top retirement mistakes people make. However, in the interim, please subscribe to this channel for notifications on future videos. Mistake number 1, not knowing beneficiary taxation rules. The new rule that went into effect in 2020 states that non-spousal beneficiaries of retirement accounts must take distributions and pay taxes no later than 10 years after they inherit these accounts. Under the old rules, the beneficiaries of inherited retirement accounts could spread their distributions and taxes over their lifetime. Because of this 10-year limit, you may be better off spending your retirement savings on your own living expenses in retirement rather than leaving these savings to your children that might be in a higher tax bracket than yours in retirement. Mistake number 2, improper beneficiary designation. Beneficiary designations on retirement accounts take precedence over instructions in a will or trust or any other document. The retirement account beneficiary designations override the trust. Simply naming beneficiaries in a revocable living trust does not govern the distribution of retirement accounts after death. The beneficiaries named on the beneficiary form benefit from probate avoidance, regardless of what the will or trust says. If you don't name beneficiaries on the retirement account, the assets will likely pass to your estate and potentially be subject to probate delays and costs. It is important to review and update beneficiaries after major life events such as marriage, divorce, birth, or death of a family member. There are known cases where people after divorce updated their will and trust, but not the beneficiary form. This resulted into a spouse inheriting retirement savings. Updating beneficiary forms protects your loved ones and the money that you have worked so hard to save. Mistake number 3 is not rolling 401k savings to personal IRA. When you leave your workplace, you have two options. You can leave your savings in the employer's 401k plan, or you can roll over the savings into personal IRA. If you roll over, you have several key benefits, such as more investment options, potentially lower fees, simplified management of your assets in one place, more flexible distributions and conversions, and a few more. You basically gain control of your retirement asset. Mistake number 4, not knowing rollover rules. There are two ways to transfer IRAs and 401ks, direct rollover and indirect rollover. Direct rollover transfers funds directly from one institution to another without you getting a check. There is no tax consequences, no mandatory withholding, and you can do it as often as you want. With indirect rollover, you need to be more careful and not to make taxable mistakes. With this rollover method, the money goes from the institution to the individual, and the individual has 60 days to deposit the money into a retirement account. With indirect rollover, you are allowed one rollover every 365 days. Additional rollovers trigger immediate taxation at ordinary income level. Mistake number 5, not understanding Roth conversions. Roth IRA is the type of account with tax-free capital growth and tax-free withdrawals in retirement. You contribute money that is already taxed and your money grows tax-free. There is no taxes on capital gains, interest, or dividends in the account in the future or when you take out the money. Doing the conversion process in a correct way is very important because there is no way to recharacterize the funds if you decide that the conversion does not work for your particular circumstances. Generally, Roth savings and Roth conversions are beneficial if you are younger or have at least 5 years to needing the money in retirement, and if you believe that your tax bracket today is lower than what it will be when you reach retirement. Mistake number 6, missing a required minimum distribution, RMD. You must start taking initial RMD by April of the year after you turn 73. All future distributions are due by December of each year. Misdistribution triggers a 25% tax on the RMD amount that is not taken. This is the most common mistake IRA owners make. If you have retirement money in an IRA and 401k, the RMDs for each of the account types work differently. For IRAs, if you have multiple IRA accounts, you can take RMDs from any combination of IRA accounts. If you have multiple 401k accounts, you have to calculate and take RMDs from each of the accounts. These accounts need to be treated separately for RMD purposes. You cannot commingle IRA and 401k RMDs. If you do, you will incur a 25% penalty. This is why when you leave your employer, roll over 401k into an IRA account for multiple benefits. Mistake number 7, chasing higher returns. When you start investing, you are taking risks and chasing higher returns because you have a job, a safety net, and you have time until retirement. When you are in retirement or nearing retirement, chasing higher returns is risky, especially if you're relying on retirement savings for living expenses, since you have less time to recover from investment losses. Maintaining a balanced and diversified portfolio is a much safer choice. Financially literate investors tend to focus on risk-adjusted returns rather than chasing past returns when allocating their retirement assets. For retirees, protecting principal and generating consistent income from investments is generally more important than seeking maximum returns that comes with higher risk. Low-risk investments like bonds, dividend stocks, treasuries, and CDs may be a more suitable option. Mistake number 8, ignoring portfolio volatility. Volatility in retirement is not your friend and can ruin your retirement plans. P/E ratio of S&P 500 can be used to assess valuation of the S&P 500 stock market index. High ratio suggests that the stock market is overvalued, and vice versa is true as well. The average P/E of S&P 500 in the last 10 years is about 18. Today, in May of 2024, the P/E ratio is close to 28, which is 55% over the 10-year average. High P/E ratio compared to a historical P/E ratio may indicate that the market is overvalued and may go down at some point. To get closer to the average, stock market declines periodically. If it goes down at the time when you need the savings money for living expenses, this may create a problem. When markets decline while you are working, this does not make much of the difference. You can absorb the volatility since you have your job as your safety net that provides you the income and you're not relying on your savings. Volatility is not your friend when you are relying on your investments for living expenses. Maintaining a balanced and diversified portfolio is much safer choice when allocating your retirement assets. All or a portion of your portfolio invested in lower risk investments like bonds, dividend stocks, treasuries, and CDs may protect you from market volatility. In summary, these are the most common and costly mistakes people make with their retirement accounts, and I hope that you have a better understanding now how to avoid derailing your retirement plans. Please subscribe to this channel to be notified on future videos, and thank you for watching.